Hello everybody, JR with Secure Metals. Welcome to my research video. Today is the second day of October, 4:45 p.m. Eastern Standard Time. Market is closed. In this video, no technicals. The technical analysis will be out tomorrow. And I hope you watched my last video. A lot of very spot on accurate predictions. I predicted that the market, the Dow Jones, had a possible false breakout, and anytime we see a false breakout, we expect a big move in the opposite direction. And guess where the Dow Jones is? When I made that video, 17.1.5, and right now sitting at around 16.7 plus. Okay, I also predicted that gold would find some support at around 12.06, and silver would find some support at around 17. And that the US dollar would find some resistance at around the high 85s, and currently trading at around 85 3/4 from a high of 86. So only time will tell if the dollar is going to continue to rally, but it does seem very overbought, but only time will tell at this point. This video, trying to make it under 15-20 minutes. And I'm going to show some articles, and I'll also put these two videos. This video here doesn't do a lot for my confidence in the Federal Reserve. And this is why we buy precious metals, right? We buy precious metals because it's a hedge against inflation. It's a hedge against the chaos that's going on. Though prices are going down, remember your purchasing power is nice and stable. It's very safe. Again, if you're not taking advantage of these discounts that the market is offering, you're doing your portfolio a huge disjustice. Again, being that ECB rates are at negative. Draghi just announced this morning that he cannot lower interest rates any lower. They're at negative. They're in negative territory right now. And anyway, let's get on with it, right?
It's very interesting when you're in the financial business to try to figure out why markets behave as they do. And it's tough. I mean, a lot of people think they can do it very easily. Mm-hmm. But we really can't forecast all that well. We pretend that we can, but we really can't.
This guy really just said what I think what we all knew, but wow, unbelievable.
We pretend that we can, but we really can't. And markets do very weird things because it reacts to the way people behave, and sometimes people a little screwy.
You just learned this?
Classic. We have these bankers that make believe they know exactly what the outcome of this whole charade that's playing out. They really don't. Now, again, precious metals is kind of like your insurance policy. You hope you never have to use it, but eventually you will, because again, they're never going to stop trying, and that's the goal. The goal is, I don't know if the goal is to wipe everyone's savings and transfer the wealth from all the guys at the bottom to all the guys at the top. I don't know if that's the main goal, or if they're just really trying, they just can't get it right. But again, trying to read the minds of millions and millions and millions, actually billions of market participants, I would imagine that it's just an extremely tough job. I don't know that we'll ever be there. Anyway, that definitely doesn't do anything for my confidence in the Federal Reserve. Not that I had that much confidence in it. Another video here by Charles Nenner. Check out what he has to say.
The price target on the S&P was 2020. We hit 2014. That's the first thing. Second thing is, we work with cycles that will tell us when that tops and when it bottoms. And cycles stopped, so we're totally out of the market. I dare to predict that for the next many years, you will not see the S&P more than 5% higher than this. And there's a major thing coming down. I'm talking about far in the future. Major collapse coming down, starting in 2018 till 2020. And in 2020, the new bull market will start.
So I want to know, in terms of your prediction, as you're saying, for 2018 or 2020, what do you think is driving that? Do you think it's the Fed and the central bank intervention?
I think the big problem is the deflation, which I'm saying every year. Europe is already close to deflation. Japan is still in deflation. China has a very low inflation. And if the dollar continues to rise in the United States, we get deflation over here. So the big problem is the deflation, and I don't think the investors are ready for it for the moment.
Charles, how do you think deflation will actually manifest itself? Because right now, in the most recent quarter, we saw the dollar surge more than 9%. That's the biggest move for the dollar since the third quarter of 2008, when, of course, it was the financial crisis that was front and center and just beginning at that moment. So do you think that because we're getting such a strong dollar, that is a precursor to deflation as you see it?
Well, first of all, we have to take a look, and I don't know if you can agree with me, but if you look at the numbers, the biggest part of the world is already in deflation. Here is still so-so, but like I said, if the dollar continues to be strong, we get the deflation exported by the Europeans, and we're in big trouble over here, especially because we owe so much money. Now, deflation and inflation of about 0% was the norm between 1800 and 1970. So we had bull markets over there. The only difference now is that we owe so much money, and in deflation, you have a big problem of paying back.
Charles, I just got to know, I'm curious, if you talk about these longer-term calls about there's going to be a deflationary environment and you see the markets going down that much, what exactly are you advising clients to do besides just go all to cash? Is there a way that you're having them play it in this medium to longer-term call that you're trying to make?
Well, the good thing is because we don't manage money, so we can be honest and neutral. So we don't have to be buyers, we can also be sellers. So sometimes there's no way to make money and you have to be very careful, which is now. So the best thing is to be in cash. We're actually waiting. Soon we expect a low in gold, so we think we'll go back into gold. But for the rest, I mean, the euro is bad. We don't trust the bond market, so where should we invest?
So there it is. So it's nice to find someone with the same views. You know, I've been saying that the upside on the market is quite small versus the downside. So against your risk versus reward is just a little bit, I guess, uneven. So small reward versus huge risk. So again, I've been saying time after time that I don't trust this market. Sometimes it's not bad. Stay in cash. Of course, your precious metals, that's always mandatory in any portfolio, 5-10% minimum. But again, I like nice to find someone saying not to go into the market just the way I've been saying it. Again, just the risk versus reward is I don't think it's just there yet. He did mention that he was waiting for a low to recommend gold. So again, the question is, when is the low going to be? I think the lower we go, the closer we get to the floor, right? So I can't imagine we're too far off from there. He is predicting another economic collapse, and God help us with that, right? So meanwhile, here's what the super rich are doing, right? If you set shares of value, by the way, all articles will be in the link below. All you have to do is scroll down and click on the links. I'm not going to read all the articles in full. I'll just read some of the articles, a small portion of them. So zero hedge. Meanwhile, here's what the super rich are rushing to buy. If you said shares of BABA, B-A-B-A, you'd be wrong. If you don't know what BABA is, you haven't been watching the mainstream media, because I'll tell you, talk about pumping and pumping and pumping. For the last month, all you hear on the TV is Alibaba, Alibaba, okay? If you said shares of Alibaba, you were wrong. According to the Telegraph, the exodus out of paper wealth into hard assets is reaching a fever pitch as the super rich are looking to protect their wealth through buying record numbers of Italian job-style gold bars, according to the Bullion experts. Italian Job is a movie. If you've never seen that movie, basically they're trying to steal a tremendous amount of gold, and the bars basically were huge gold bars. The number cited by the paper are impressive. The numbers of 12 kilograms gold bars being bought by wealthy consumers has increased 243% so far this year when compared to the same period last year. These gold bars are usually stored in vaults and central banks. All right. The sale of 1 kilogram bars worth 25,000 pounds have doubled during the last 3 months. When compared to the same period last year, Telegraph reports, according to ATS Bullion sales figures. Okay, great article. You should check that out. Okay, another article by Zero Hedge. Is this the most confused Fed ever, just two headlines. I think this explains what this guy said here just a few minutes ago.
Can't forecast all that well.
These guys are just have no clue of what they're doing. Okay, confused. We can now put to rest the debate whether the most transparent in its communication Fed is also the most confused, if not to use a far more derogatory word ever. On one hand, Bloomberg reports that Fed Chairman Yellen laments that she wants investors to prepare for the possibility that the Fed will raise interest rates sooner than they currently project, and yet her words are going unheeded. Okay, here's the report by Bloomberg, okay, where she said that. Got a video as well. And yet, on the other hand, virtually at the same time, Bloomberg also reports that the man who many say is truly in charge of the Fed and certainly its markets moving branch, the 147 times levered New York Fed Goldman's former employee Bill Dudley, warns about the need for patience on interest rates increase and may require letting the economy run a little hot. By a little hot, he means letting the global asset bubble Citi warned about yesterday grow to truly monstrous instead of merely epic proportions. There's the other figure, the other article, okay? Completing the comedy, third Bloomberg commentator Richard Breslow accurately summarizes the situation. For Fed to rail against what the market is doing seems to me the height of absurdity. They should probably put all their speeches together, read them to each other, and find some way to talk coherently to the market. But why, after all these Princetonian demigods, are all the bullish case they have left? If the battle with bull crap, I have two kids, so I don't like to curse. If the battle with bullcrap strategy fails, it's game over, as the last thing the Fed can afford is to tell even a remote version of the truth. Said otherwise, the moment the Fed starts talking coherently to the market is the moment the market plunges. So until then, monetary gods talk in mysterious ways. So again, we see the confusion in the market. The market is extremely volatile. Extremely volatile. Dow Jones down 250 points, down another 100 points today, 100 plus points today. Another good article here you'll find at the link below. Another conspiracy theory becomes fact. The Fed stealth bailout of foreign banks goes mainstream. Definitely want to check this article out. Basically talks about all the hidden bailouts that the Fed was forking out. Good article. You should read that. COT report shows JP Morgan holds lowest silver short position since 2008. Silver, the commercial net short position declined a hefty 6,792 contracts, or 37 million troy ounces. The commercial net short position is now down to 16,767 contracts, or 87 million troy ounces. Remember that the COT is where the contracts that are open that are long and the short contracts. Now, usually there's always a pretty decent size amount of short contracts, obviously, because the miners are hedging, right? So it seems that these miners are not shorting. They're not hedging the way they normally do. So again, prices currently at $17. It doesn't seem too much of a need to hedge, at least at this point, right? He also goes to state how JP Morgan, Ted Butler also mentions that JP Morgan's short position in silver is now down to 11,500, their lowest short side corner of the COMEX futures market since taking over the short position of Bear Stearns in 2008. And not to be forgotten in all of this is the equally extreme short in gold. The commercial net short position only declined by 11,900 contracts, or 1.9 million troy ounces. The commercial net short positions in that precious metal now stands at 6.43 million troy ounces. JP Morgan, apparently they are still long. Ted Butler was rather surprised to see that there was no change at JP Morgan long corner of the COMEX gold market. It still remains 25,000 contracts, 2.5 million troy ounces. So again, JP Morgan telling everyone that gold is going to 1050 and 950. Look what they're doing. They're actually holding 25,000 contracts that are long, okay? So again, like I said on my last video, these guys will tell you one thing, but they're doing the exact opposite. Okay. All right. What's next? Last thing I wanted to cover here was the sales. Now, obviously, there's many different types of bullion. We have coins, bars, and so on. I actually went to the Mint, to the U.S. Mint. You can actually go on their webpage, and it actually tells you what they've sold every year. Buffaloes, rounds, and American Eagles. American Eagles are obviously the most popular. So I just did the numbers on the American Eagles, but pretty interesting. 2000 and 2007 Gold Eagle sales, 5 million ounces of Gold Eagles, right? So between 2000 and 2007, 7-year period, 5 million ounces. Actually, it actually goes back to 1986, and from 1986 to about 2005, 2006 actually equals the same amount of gold sales in the last 5 years, and this year is still not over. And keep in mind, 2008, at the end of 2008 was when we had a huge spike in bullion sales. So Gold Eagles between 2008 and 2014, 9 million. So in this 7-year period, only 5 million. In this 5-year period, 9 million. Silver Eagles in the last from 2000 to 2007, 7-year period, 75 million. In this 5-year period, and again, this year is still not over. We are at a whopping 229 million. So in the last 5 years, we've actually sold more ounces than we have in the last 20 years of silver. Okay. So since 2007 all the way back to 1986, 21 years, it barely touches this number here, 229 million. So again, and the reason why I showed this is because you have to keep in mind that between 1986 and 2007, the average price of silver was roughly what, $2 or $3 at best, $3.50, $4, and you have less than 229 million in ounces sold. This tells you that people currently find more value in silver within the last 5 years. Let's say an average price of 30 or 35. They find more value at these levels than they did at $3 or $4. So that's a huge indication for the market that the supply, that the demand is still there, no matter what these pundits here are telling you on mainstream, right? And of course, with prices below or at production costs, miners will be forced to shut down or halt production. There's an article here and basically said that a lot of junior miners were shutting down, and they're not even going to their annual conference because they don't want to pay for their booths. So it's pretty interesting. And of course, miners will be forced to shut down or halt production. Supplies will dwindle and prices will rise. Plus, keep in mind, there's a huge excess of money in the system. And when all that money goes to precious metals, all at the same time because of a panic, prices will rise extremely rapidly. And the last thing that I want to show is something that I've been thinking about for quite some time. I was wondering, why is it that during a collapse, all businesses suffer, right? If you're a good businessman, if you have a successful business, why does your business fail during a collapse? So basically, you're a good guy, you know what you're doing, but your business fails. Why is that? And basically, my conclusion is that Keynesian economics, current economic structure, these guys predict current what the current situation is, right? So lower interest rates stimulate the economy now, right? Austrian economics predicts the future, right? So lower interest rates, yes, they might stimulate the economy, but low interest rates distorts the market, right? Leads to malinvestments. Malinvestments is something that Austrians coined, and is basically just investments that are doomed to fail from the beginning. Money injection stimulates the economy. Yes, it does, but it does it right now. But it also leads to more malinvestment. Why would so many successful business fail at once? Depression, and basically in a depression or in a recession. In a free market, the market participants decide which business will prosper and which businesses will fail. In 2008, when most businesses were failing because of the collapse, they didn't fail because business owners didn't know what they were doing. They failed because so many businesses that would not have been financed in the first place were financed. When interest rates are too low for too long and liquidity is in abundance, the market participants are allowed to borrow without limit, whether they qualify or not, whether they are good or bad at what they're looking to start. The free market prevents this from happening because when too many loans are issued and bank reserves begin to dwindle, money becomes more expensive and less borrowers qualify. All right. And this is not even mentioning what low interest rates does to savings. It obviously encourages more aggressive investments. And that's probably one of the reasons why we saw the Dow Jones hit 17K, possibly higher, 17.5, 18,000 maybe, before we see the final huge dip. Okay. Quantitative easing is ending next month. And again, the market is in for a lot more volatility. So again, as I've always said, you know, if you're going to invest in this market, do it conservatively. There's no need to put 80-90% of your money in this market. Again, if 401ks, IRAs, we're able to transfer precious metals into your 401k, IRA, retirement funds without any penalties. Contact your representative. Contact me if you need to. And get your hands on some precious metals, because what's coming is it's going to come and it's inevitable. And again, like I said before, we're wrong until we're right. And these Keynesians, they're right until they're proven wrong, right? Let's not forget that supposedly none of these Keynesians saw this housing bubble, right? Here's Bernanke saying that there will be no housing market crash.
Ben, there's been a lot of talk about a housing bubble, particularly, you know, from the Fed, from all sorts of different places. Can you give us your view as to whether or not there is a housing bubble out there?
Well, unquestionably, housing prices are up quite a bit. I think it's important to note that fundamentals are also very strong. We've got a growing economy, jobs, incomes. We've got very low mortgage rates. We've got demographics supporting housing growth. We've got restricted supply in some places. So it's certainly understandable that the prices would go up some. I don't know whether prices are exactly where they should be, but I think it's fair to say that much of what's happened is supported by the strength of the economy.
Tell me, what is the worst case scenario? So we have so many economists coming on our air and saying, oh, this is a bubble and it's going to burst and this is going to be a real issue for the economy. Some say it could even cause a recession at some point. What is the worst case scenario if, in fact, we were to see prices come down substantially across the country?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis. So what I think is more likely is that house prices will slow, maybe stabilize, might slow consumption spending a bit. I don't think it's going to drive the economy too far from its full employment path, though.
So there you have it, guys. Again, protect yourself against these guys. Protect yourself against this right here.
But we really can't forecast all that well. We pretend that we can, but we really can't.
So make sure, again, you assess your portfolio, add some precious metals to your portfolio, and again, give your representative a call. And I hope you enjoy the video, guys, and I'll see you next time. Next video analysis will be tomorrow. A lot to go over tomorrow, okay? Thanks for joining me. Enjoy the rest of your day. Bye-bye.